First, though, Fed official Barkin talking at the CNBC CFO Council in Washington, D.C. Let's listen in.
Lousy job.
33% fair. That's what I heard. So
that's all you need, right? You got a low bar, huh?
86.
I want to start off with where Tyler and I just left off. 5.2% GDP growth in the third quarter. Is that too fast? And to what extent do you expect to slow down now?
Well, I've been saying from the beginning that there's a disconnect between the data that's coming in, especially in the third quarter, and what I'm hearing on the ground from talking to people, including many of you. And what I was interested in the revision is the total number went up, but the consumer spending number came down.
Right.
And that's more consistent. That's directionally more what I'm hearing, which is when I talk to businesses, and I'll be interested what you have to say in the group about CapEx, I'm not hearing the sort of savage cutback in CapEx that you hear before a recession. I'm hearing people investing through the cycle. That's business investment. That is what got marked up in this revision. Consumer spending, I do hear consumers at the low end being stretched, at the middle trading down. At the high end, they're, of course, still spending. But, I'm hearing that starting to pull back. And that's more of what we saw with that revision this morning.
I think it was interesting, Tom. I guess it was a month ago. You kind of took a break with the data. And you said, I see this strong data, but I don't necessarily believe it. Yeah. What are you expecting in this quarter? How much of a slowdown do you think is going to happen with the economy?
It's going to be a weird quarter from a reporting standpoint because it's Christmas. The seasonality has all gotten messed up. And if you remember last year, we had a very strong October Prime Day. We actually had pretty weak November, December, and then we had a very, very strong January. So when you look at the year-over-years or the Black Friday stuff, you're going to have to adjust for that because it's going to be a different kind of stuff. And COVID sort of messed up the seasonalities even more broadly. But I'm hearing consumer slowing down. I mean, that's what I'm hearing. I'm not hearing consumer falling off the table. I'm hearing normalizing, not recession. But I am hearing consumer slowing down.
Is it all together, and I mean the consumer, the business investment, the government spending, enough of a slowdown for you to believe we're on a trajectory to get inflation back down to the 2% target?
I mean, I'm skeptical that price setters at this point have gone back to where they were pre-COVID. One of the exercises I like to do in a group, maybe we can do it today, is to ask, how many of you are back to your pre-COVID pricing levels? How many are actually, reducing? And then how many are increasing? And I'll hear 50, 60%. It's a lot like what you thought about the Fed. 50 or 60% will be saying, we're still increasing at higher than pre-COVID levels, whether that be because of margins that haven't fully been recovered or costs that are still being faced, wages being a big part of it, or frankly, because they can. And, before COVID, I think 20, 30 years of 2% inflation, price setters had basically just been disciplined to say, don't bring something outsized into this conversation. We don't have the ability to convince buyers to buy it. And that's been reinforced by globalization and the access to low-cost content from other places, reinforced by e-commerce, the ability to shop around, reinforced by the power of big manufacturers like the automakers and big box retailers to push back. And all of that meant that don't bring in price increases. That's just not something you can sell. And then, of course, what happened during COVID is the combination of huge cost pressure and supply chain outages meant that you could do something. And guess what? People passed them through. And so, and you guys are all CFOs, I just don't know that people are going to give up that power until they have to. And there are people that have to. I mean, as I talk to people in apparel, that's clearly gone to the other side. But until you have to, it puts money to the bottom line faster. There are costs that have to be recovered. I still hear people doing that. So I think they're going to have to get convinced. And as somebody said before I started, I don't think 5.2% GDP growth or 3.6% consumer spending growth is what convinces people that they no longer have pricing power.